Welcome to the deep dive.
Great to be here.
Today, we're looking at a set of sources, really focusing in on the New Zealand economy.
Yeah, and these sources, they make a pretty strong argument, don't they?
They do. They argue that what New Zealand might be facing isn't just, a standard downturn,
No, they're calling it a slow-burning economic crisis, suggesting it's something deeper.
right, rooted in fundamental structural issues within the economy itself. That's the core idea we're digging into.
Exactly. So the plan is to unpack that argument for you.
We'll go through the sources, understand what they mean by structural crisis, and pull out the key insights, the core problems they identify.
Okay, so where do they start? What's the foundational issue according to these sources?
It kicks off by highlighting what they see as a major structural overdependence
Overdependence on what specifically?
on just a few key sectors. They pinpoint dairy, agriculture more broadly, property, and tourism as the main pillars.
And the worry is that this narrow focus makes the whole structure a bit, well, vulnerable.
Precisely. Especially, the report notes, with global conditions shifting.
Things like climate risks,
Yeah.
geopolitical shocks, that kind of thing.
Exactly. Those factors are mentioned specifically. Relying on just a few things gets riskier when the ground underneath is, less stable.
Right. It makes sense. So let's dive into that first pillar they mentioned, the export engine.
Okay. The material points out that primary exports are just overwhelmingly dominant. We're talking around 60% of New Zealand's total goods exports.
60%. Wow, that's huge. Is there a breakdown?
Yeah, and it's quite revealing. Dairy alone is about $18 billion. That's roughly 26% of all goods exports.
A quarter of exports just in dairy.
And heavily reliant on China, too. The source says 26% of that dairy goes there.
Okay, so concentration risk within a dominant sector. What else?
So you've got meat, beef, and lamb. That's around $8.4 billion, maybe 12%.
Also subject to global price swings, I imagine.
Very much so. Forestry adds another $5 billion, about 7%. But here's an interesting point the source makes. It's mostly raw logs, not much processed timber or higher value wood products.
Ah, so that's the value add issue they talk about.
Exactly. It's about capturing more economic benefit by doing more with the raw material before you export it, selling furniture instead of just logs, essentially.
And the sources argue New Zealand isn't doing enough of that.
That seems to be the implication, yes. Less value captured locally.
Gotcha. What other exports are mentioned?
Seafood is about $2.5 billion, 3.5%. The report notes its growth has been stagnant, partly linked to climate change impacts.
Okay.
And horticulture, things like kiwi fruit, apples, wine, that's around $3.5 billion, 5%. Has good brand potential, the source says, but still a relatively small slice overall.
Right, so you add all that up. It's overwhelmingly primary products.
It is. And here's the stark contrast highlighted in the material. High-tech and manufacturing goods exports.
How do they fare?
Less than $2 billion. That's under 3% of total exports.
Under 3%.
Yeah, and the report explicitly calls this extremely weak by OECD standards.
Just to remind listeners, the OECD is basically the club of developed nations.
Right, so compared to its peers, New Zealand's high-value export sector is, well, tiny, according to this analysis.
Okay, so why is this heavy primary reliance seen as such a liability now?
The sources list a few key reasons. Environmental constraints are becoming tighter limits on land, water use.
Makes sense.
Then there's that trade concentration risk we touched on, especially with China for dairy.
Being too reliant on one market.
And finally, that poor value add. Exporting raw stuff rather than sophisticated finished goods. It limits the economic upside.
Okay, so that's the export picture. What's the next major structural piece the sources focus on?
Property. Real estate gets a huge amount of attention in these documents.
Not just as housing, but as an economic driver.
Exactly. It's described as the main investment vehicle, which, the argument goes, distorts where capital flows in the economy, away from potentially more productive areas.
And how big is its economic footprint, according to the report?
It's significant. Real estate services are cited as around 11% of GDP.
11% just for the services side.
And construction adds another 5–6%. So you combine those, and it's a massive chunk of the economy tied up in building, buying, and selling property.
And this focus, they argue, creates structural risks.
Yes, that's the term used. They point to the huge house price boom, prices rising 130% between 2011 and 2021.
Which the report says was one of the steepest rises globally.
It does, and then they fell quite sharply, didn't they?
Yeah, about 16% down from the peak in late 2021 through to April 2023. That volatility itself is a risk.
There's a specific worry highlighted now, right? Mortgage resets.
Mm-hmm. This is a big one. The sources note that around 40% of mortgages taken out in 2020-21, when rates were super low,
Below 3% in many cases.
right, those are now resetting or due to reset at much higher rates, potentially 6% or more.
Ouch. And the implication of that is,
Significant household debt stress, as the source puts it. People's monthly payments could, double. A huge squeeze on budgets.
and that's happening alongside a persistent affordability problem, isn't it?
Absolutely. The report cites the median house price at 8.8 times the median household income.
Nearly 9 times income. How does that compare internationally?
Well, the sources contrast it with the usual OECD affordability benchmark, which is generally seen as around 3 times income.
So 8.8 is way off that scale.
Miles off. It underscores that the property market isn't just about cycles. Its sheer scale and unaffordability have deep structural consequences for households and potentially financial stability.
Okay, so we've got this narrow export base, heavily reliant on primary goods, and this huge focus on property. What's the third angle the source brings in?
They talk about an innovation gap.
Meaning?
Well, the argument is that despite having an educated population, New Zealand seems to struggle translating that into innovation and, crucially, productivity growth.
Is there data in the report to back that up?
Quite a bit, actually. They look at R&D expenditure spending on research and development.
Right.
As a percentage of GDP, New Zealand's at 1.4%. The OECD average, 2.7%.
So roughly half the investment level of comparable countries.
Pretty much. And you see the potential outcome of that, they suggest, in productivity figures.
How so?
Labor productivity growth between 2012 and 2022 averaged just 0.3% per year in New Zealand.
0.3%, that's very low.
It is. The OECD average over that same period was 1.5% annually. That gap really compounds over time.
And this links back to the export mix too, presumably.
Definitely. Remember those high-tech exports? Less than 3% of the total.
Yeah.
The report brings this up again here, noting most developed nations are over 10%. It suggests a lack of economic diversification and sophistication.
They mentioned an economic complexity index too.
Yeah, New Zealand ranked 50th in 2023. That's well below peers like Finland at 11th or even Australia at 38th. A lower rank generally means you export simpler, less processed stuff.
So what are the key problems driving this innovation gap, according to the sources?
They list a few things. Chronic underinvestment in R&D and venture capital, that's the money for new, innovative companies.
Right.
A tech ecosystem that's seen as limited beyond a few well-known successes like Xero or Rocket Lab, which get mentioned as examples.
Right.
And critically, what they call significant brain drain.
Skilled people leaving. Is there data on that?
Yes, the report cites over 40,000 net citizen departures in 2023.
40,000 in 1 year.
And the source explicitly describes these as largely skilled professionals heading to Australia and beyond. So the people you'd arguably want driving innovation might be leaving.
Okay, that's quite a concerning piece of the puzzle. Is there a fourth major factor?
Yes, the final big theme the sources weave into this structural analysis is immigration and demographics.
How does that fit in?
The report frames it, particularly in recent years, as a potential issue of quantity over quality,
Meaning?
suggesting the immigration strategy has become more focused on filling immediate, often lower-skill labor shortages, while at the same time, the country is losing those high-skill citizens through immigration.
Are there numbers on the immigration side?
Big numbers for 2023. A record net migration gain of 126,000 people.
A gain. So lots of people coming in.
Yes, but, and this is the source's emphasis, this game is described as being mostly lower-wage temporary workers.
Okay, so contrast that with the outflow.
Right, that net loss of 40,000 citizens in the same year, which the source specifically labels as skilled workers leaving, mostly to Australia.
So skilled people out, lower wage temporary workers in. Is that the dynamic described?
That's the picture painted in the report, yes. It suggests a potential mismatch. They point out that over half of recent immigrants are reportedly working in sectors like caregiving, retail, agri-services.
Lower wage sectors.
Predominantly, yes. Which leads the source to talk about a lack of skill alignment with the needs of a higher value economy.
And what are the consequences of this pattern, according to the analysis?
They term it structural stream. High population growth, but concentrated in lower-wage jobs, puts pressure on public services. Healthcare, housing, education are mentioned. Because the tax base generated might not keep pace with the demand for services. That seems to be the implication. Plus, they suggest it indicates a lack of long-term planning linking immigration to strategic high-value sectors. And they argue it contributes to eroding productivity due to low-value job growth.
There's also a demographic point mentioned, isn't there, about aging.
Yes, the sources note the over 65 population is currently 18% and projected to hit 21% by 2034.
So an aging population.
Right. Which the report links to future challenges, a shrinking workforce relative to dependence, and rising healthcare and pension costs, adding another layer of structural pressure.
Okay, so pulling all these threads together, the narrow exports, the property dominance, the innovation gap, the specific immigration and emigration patterns.
The sources argue they combine to create what they call a shallow, stretched economy.
That's a pretty evocative phrase, shallow and stretched.
It captures their core argument, I think. They reiterate the main structural weaknesses, that 60% reliance on basic commodity exports.
The huge chunk of GDP tied up in real estate and construction, which they argue doesn't boost overall productivity.
Right. The underinvestment in innovation, the weak high-tech sector compared to peers.
And this immigration dynamic skills leaving, lower wage labor arriving, creating mismatches and strain.
All leading, according to the data presented, to productivity growth that's amongst the worst in the OECD.
They include a comparison table, don't they?
Yes, comparing New Zealand on metrics like R&D spend, high-tech exports, brain drain, immigration quality against places like Australia, Finland, Singapore. And the picture painted is, well, challenging for New Zealand by those comparisons.
So after laying out this diagnosis of deep structural issues, do the sources offer any prescriptions, any ways forward?
They do offer some high-level recommendations, yeah, aimed at tackling these root causes.
These aren't quick fixes, I assume.
No, definitely presented as longer-term structural shifts. First, they suggest rebalancing investment. How?
Actively trying to shift capital away from just speculative property investment and channel it more towards productive areas like high-tech manufacturing and R&D.
Okay, what else?
Second, reforming immigration policy. The suggestion is to prioritize skills more explicitly and align immigration better with long-term strategic economic needs, not just filling short-term low-wage gaps.
Makes sense if the diagnosis is correct. Third,
Diversifying exports. Finding ways to incentivize and support growth in higher-value sectors. They mention things like biotech, clean tech, digital services as examples.
moving up the value chain.
Exactly. Fourth, a direct focus on improving productivity across the economy.
Through things like
Upskilling the workforce, accelerating digital transformation in both public and private sectors, making everything more efficient.
And is there a final recommendation?
Yes, related to the first point, they suggest potentially shifting tax incentives, moving them away from favoring speculative property gains and towards encouraging enterprise, innovation, and investment in actual businesses.
Right, try to change the economic signals. Precisely.
So we've done our deep dive into this particular set of sources and their analysis of the New Zealand economy.
And their argument for why it might be facing a slow-burning structural crisis.
Yeah, the core message seems pretty clear. The challenges identified aren't just part of a normal business cycle.
No, they're presented as being deeply embedded in the structure, the export mix, the property market's role, the innovation capacity, the population dynamics.
And the sources certainly build a case that tackling these fundamentals is crucial if the country wants to achieve, sustained long-term prosperity.
The alternative, they seem to imply, could be ongoing stagnation if these structural issues aren't addressed head-on.
Okay, so thinking about everything we've just unpacked, that heavy reliance on just a few primary sectors, the overwhelming focus on property, the lag in innovation and productivity, and those specific patterns of who's arriving and who's leaving. It really does paint a picture of complex, interconnected challenges.
They all seem to feed into each other in some ways.
They do. So considering the interconnectedness and based purely on the analysis presented in these sources we discussed, which of these structural pillars do you, listening right now, think would be the single most critical one to start addressing? If you had to pick one foundational issue to tackle first to unlock progress on the others, which would it be? Is it the export mix, the property obsession, the innovation deficit, or the migration patterns? Something to think about.